Hi guys, welcome to 365 days, 365 CFA concepts. The concept that we are going to study today is insurance companies. First, let us take an example of car insurance. Let's say, for example, you go to an insurance company and buy insurance for your car. Obviously, it is not going to come for free. You will have to pay a certain premium, right? Tomorrow, in an event of damage to your car or there's an accident of your car, whatever loss you're going to suffer, insurance company is going to compensate for that loss in the form of giving a amount to you, and that is called as claim, right? Of course, it is subject to certain terms and conditions. But the point is that they have compensated for the loss that you have suffered, right? Ultimately, they collect what? They collect insurance premium and they provide a risk reduction for you. How risk reduction, sir? Whatever risk that you are facing, what risk? Risk of damage to your car. Whatever loss that you are going to suffer from the risk of damage to your car has been compensated by the insurance company to you because you bought their insurance, that is car insurance, right? And that is what the business model is. Sir, what do they do with the amount of premium that they collect from us? They invest in certain assets, right? Because tomorrow, if the claim comes, if they have to pay a compensation to you, ultimately they will sell those assets and they will pay your money back. And that is what the first point is and talks about ultimately what an insurance company does. Sir, what exactly is the business model of insurance company? Let's take an example of life insurance for that. Let's take an example of life insurance for that. We take an example of life insurance. Now, let's say we are talking about a life insurance that will pay you rupees 1 crore in an event of what? In an event of death. In event of death. And I mean, sir, death, is it that random? No, sir. If you die before the age of 60. So you purchase a life insurance, that life insurance, whatever that, that insurance is, it will pay you 1 crore rupees if you die before the age of 60. Of course, not to you after you die. That's logical. Of course, to your family members. But the point is that this is what the policy is, where you will get 1 crore rupees before age of 60 if you die. Now, obviously, this is one of the types of insurance. There are different types of insurance, but we are not going to get there today. But the point is that you tell me from an insurance company's standpoint, put yourself in the companies, in the shoes of the company which is selling insurance. Where would the risk of loss be more? Where would the risk of loss be more? If you have sold life insurance to 2 people, or if you have sold life insurance to 10,000 people? Sir, obviously, if you have sold the life insurance to 2 people, because even if one dies, you will have to pay them 1 crore rupees and you would have collected premium only from 2 people. But when you sell insurance policy to 10,000 people, you have diversified the pool. Out of 10,000 people, not all 10,000 people are going to die together before the age of 60. Not together, but before the age of 60, right? Essentially, you have diversified your risk of loss. You are collecting premium from 10,000 people, and essentially tomorrow, not everyone is going to die before the age of 60. Probably even if 5% of the people die, you would have to pay out 1 crore rupees to 500 people. But you get to collect premium for 10,000 from 10,000 people, right? And that is what the business model is, where they ultimately reduce the risk of loss by giving insurance policy to thousands of people, to a lot of people, because they are able to diversify their risk. Because out of 10,000 people, not everyone is going to die before the age of 60. Of course, in an event like COVID or something extreme happens, of course, that's a different scenario, but not everyone is going to die before the age of 60, right? But in case of 2 people, even if 1 person dies before the age of 60, the risk of loss is huge, right? And that is what the business model, the premise of an insurance company is. That's how they do business. Obviously, they would want to make sure that they, give insurance policies to wide variety of people, to a lot of people, because that will ultimately reduce the risk of loss. And that is what the business model is, right? So we have spoken about the first 2 points. What kind of risk does an insurance company manage? Sir, they manage 3 types of risk. First is moral hazard risk. What is that risk, sir? Moral hazard is a risk that once a person is protected, they will take more risk. A person will take more risk once they are protected against losses. So what does that mean? Let's say, for example, tomorrow you have a fire insurance and a fire breaks out in your factory. Obviously, sir, you will go to insurance company and ask for a claim and tell them, listen, my factory is burnt. Please compensate for my losses. Please give me my claim of fire insurance that I deserve. The fire insurance company, the insurance company will not give you the claim immediately. They will send a person on ground, which is called as an investigating officer. It will come and check that whether you took basic care, basic precautions that a person in this circumstance would have if they would not have insurance. Sir, what does that mean? Did you have fire extinguisher in place? When you came to know of fire, did you call the fire brigade? Did you try to make sure that the fire was put out quickly? Did you take all of these precautions, or you were taking a lot of risk? You did not put fire extinguisher. Your plan of the factory was such, which was not at all fire friendly. Basically, it was constructed in a manner where tomorrow if fire happens, it will spread out quickly. There are no vents. There is nothing like that. It will come and check all of that. And that is how they will manage the risk, which is moral hazard risk. They will manage by sending an investigating officer on ground, and he will inquire, he will check that did you take a lot of risk just because you were protected, or you behaved like a person in this circumstance who would not have insurance. And that is what moral hazard as a risk is. Related to this, another risk that they manage is fraud. They will send an investigating officer. An investigating officer will inquire that why did the factory catch fire? Is it the case of fraud? A lot of times people do or commit insurance fraud, right? Tomorrow a fire breaks out in the factory. Uh, people might do it purposely because they would want the claim that will come from, uh, the fire breakout. So the point being that the investigating officer will inquire about this particular thing as well, that what is the cause of fire? Is the reason for fire some deliberate, something deliberate? And that is what the point is. That was it on purpose? Where did the fire break out on purpose? And that is what is one of the risks that they manage, is another risk that they manage, which is fraud, by sending an investigating officer who will inquire that it was not caused on purpose. There were no purposeful damages just to collect the claim. And the last risk that they manage is adverse selection. Sir, they manage adverse selection. Sir, what is adverse selection as a risk? People who are likely to experience losses are always going to buy the insurance. Now, a person who would have a lot of health risk, who has a lot of diseases, would ultimately be the person who would go and buy insurance, life insurance or health insurance, right? Let's say a person who has a lot of diseases is more likely to buy life insurance because his chances of dying early are much more as opposed to a normal healthy person. How would insurance company manage this risk? Sir, they would ask for multiple reports. Your ECG report, your overall medical report. They would ask for multiple reports before giving out life insurance to you, right? This is how they would manage adverse selection, because they will identify quickly from your ECG report or from other medical reports that, okay, oh, this person has a lot of risk of, he has a risk of diseases and is suffering from a lot of diseases. Selling him life insurance would probably result in we playing claim to him. Okay, so let us manage this risk by charging more premium to him. And that is what adverse selection as a risk is. So, sir, to summarize, what does an insurance company do? Insurance company collects insurance premium for you and reduces your risk, right? That's the first point. What is the business model of insurance company? Sir, business model is to sell insurance to a wide variety of people so that your risk is diversified. In 2 versus 10,000 people example that we took. And the third point is that it manages multiple risks. The first risk that it manages is moral hazard risk, right? Moral hazard risk, that is the people, you are protected against the losses, they are more likely to take more risk. It manages that by sending an investigating officer. It manages the fraud as a risk as well by sending an investigating officer who will inquire that what was the purpose of fire, what was the cause of fire, was it did it break out on purpose just because they wanted insurance claim. And the third point would be, and the third risk that would be adverse selection, that the people who are more likely to experience losses would be the buyers of insurance. How would they manage this? The life insurance example that we took, that they will ask for medical reports and the ECG report and etc. etc. Right? That's it for today. I hope you guys liked the concept. Please like, share, and subscribe. Thank you so much. Bye bye.